Okay, all right. Welcome everybody. Thanks for joining the call today. And today we'll be talking about tax loss harvesting. So, quick disclaimer before we get into it. So this webinar is for educational purposes only. It's general in nature, and if you have any questions about your individual accounts or investment holdings, please contact your advisor directly. The firm only renders investment advice to clients that have signed an advisory agreement with Financial Planning Solutions, and this should not be considered tax advice. You should consult your own tax, legal, and accounting advisors before engaging in any transactions. All right, now into the fun stuff. So what is tax loss harvesting? So at a high level, tax loss harvesting is selling your investments at a loss. And essentially, the goal is to capture these losses in order to reduce your tax liability. It's most applicable to those in higher income tax brackets, as they'll have a higher tax liability. And just one important thing to note is that it only applies for taxable investment accounts. So brokerage accounts and trust accounts are examples of those. And now we'll get into some examples.
Hi, everyone. Janet Friedman. We're going to do a very simple example today to kind of demonstrate the concept. So, for example, say you bought a stock, or it could be a mutual fund or an exchange traded fund, more than a year ago for $1,000, and it's now worth $10,000, and you're interested in selling it to capture that gain on your investment. So to figure that out, you sell it for 10,000, and the cost, what they call the cost basis, your original price that you purchased this investment for is 1,000. You would have a $9,000 long-term capital gain, which is subject to capital gains tax. The next example, stock B, is the opposite. Say you bought it for $10,000 more than a year ago, and unfortunately, it has not done well, and it's now worth only $1,000, and you'd like to sell it. And if you sell it today, you would have a $9,000 long-term capital loss. So if we go to the next slide, you can see that if you just sold stock A, um, you would have a $9,000 capital gain this year. And most people are in a 15% tax bracket for long-term capital gains. So they would owe 15% of that $9,000 or $1,350 in their 2025 income tax. However, if you combine selling the stock A that had the $9,000 gain with the stock B, which had a $9,000 capital loss, you can offset the gain and loss, and you'd have zero in capital gains and owe no income tax. Okay. Next slide, please. So when we think about this throughout the year, but we particularly look at tax loss harvesting in the final few months of the year to see if we can realize some tax loss harvesting for our clients who have brokerage accounts or trust accounts. If you have losses that total more than $3,000, you can only in any given year take a loss up to $3,000. If you have losses greater than 3,000, though, you can carry over anything above that to a following tax year. So say your losses totaled $5,000 in 2025, you could take a $3,000 loss on all of your uh, buys and sells, and then carry over $2,000 as a loss to future years. It could be 2026 or a later year. And that's also a good tool for managing your tax liability going forward. So I will pass this now to Rick.
Rick, I think you're muted.
Thank you. I was muted. So I'm Rick Fingerman, one of the managing partners here at Financial Planning Solutions. So Janet spoke about tax loss harvesting for losses. There's also capital gain harvesting, which is a little unique, and we don't do this often, but there are times where it makes a lot of sense. So you might wonder, why would you do this? So basically, if you're in a low tax bracket year, and we've done this in the past with a couple of adult kids that were in between jobs, so they had low income that year. So you could actually sell something at a gain, and instead of having to pay that capital gain at 15%, like Janet pointed out, or it could be even 20% if you're in a higher bracket, it could be zero. So, if you're single and you make up to $48,350 on the federal side, you could actually sell something and pay no capital gains tax. Now, the question is, why would you do that? And the reason is because there's something called basis. So when you bought that stock, like she showed, for 1,000, and it was worth 10,000, and you had a $9,000 gain, the basis was 1,000, and we've used that basis to figure out how much tax you have to pay. So let's just say in that same example, somebody had bought something for $1,000. Now it's worth 10,000 with a $9,000 gain. We could sell that stock, realize that $9,000 gain, but pay no tax. And in fact, if we still like that investment, we could buy it back the same day and reestablish our basis to be now 9,000 or 10,000 rather, instead of 1,000. So in future years, when your income goes back up, it just means that if you sold that, you have kind of a higher basis and you'd have less of a tax liability if you did sell that. It's a little complicated. If this sounds like something that, whether it's a gain or a loss, definitely reach out to us and we can walk through, because we're trying to kind of keep this high level, and we can make this into a 6-hour webinar if we really wanted to. So we want to try to keep it simple, but there are opportunities that you could do things like that. So again, you could sell that, make that $9,000, realize $10,000 and pay no capital gains tax in this example. Next slide. But there is the wash sale rule. Now, in Janet's example, we're taking a loss. Let's say you sold that and you got that, that $9,000 loss. You'd have to wait 30 days to buy that same holding back again. You could buy something different. You could sell a technology stock and buy a pharmaceutical stock the same day. That wouldn't really make a difference. But if you bought the same thing back in that account, or actually in any other account that you own, or if you file married filing jointly, even in a spouse's account, you can't do that. Even in an IRA, you can't sell something in a brokerage account and buy that same thing back in a retirement account either. So there are some rules. You've got this 30-day wash sale rule. On the gain side, like I explained, you could buy it the same day. There's no issue. It's only when you're taking a loss. Otherwise, it's disallowed for the tax loss purpose, and the IRS doesn't like that. So be mindful of that wash sale rule. I think we're on to the next slide. Is this Andrew? Lyman.
Thanks, Rick.
Yes.
So Lyman Jackson here, one of the other managing partners at Financial Planning Solutions. So to try to sum it up in a nutshell, tax loss harvesting can provide you with an opportunity to save on taxes by combining different buys and sells that might be in a loss or a gain, and save you a little bit on taxes. There's the benefit of being able to carry that forward, especially if you have a lot of losses and you don't have any offsetting gains. As Janet mentioned, you can only deduct off of your regular income tax $3,000 worth of capital losses in a single tax year. This also allows you to, realize some losses while, basically trying to remain invested. You book the tax loss in the course of doing a tax loss sale. You do have to be out of that specific security for at least 30 days, but you can invest it in other types of investments during that time to earn some kind of a return. Next slide. It's important as you think about this kind of strategy to look at your whole tax picture. There are things to consider, such as your overall tax bracket, and will doing some of these sales and purchases cause you to potentially be in a higher tax bracket, or perhaps maybe it's on the beneficial side that taking some of these losses could actually help keep you in a lower tax bracket. Keep in mind things such as that could affect your tax situation, such as the sale of a primary or other residence that is subject to capital gains taxes that might increase your capital gain going beyond just the securities that you own. Also, keep in mind that if you receive an unusually large bonus, say from work or some other taxable windfall, that could kind of change your tax situation. So in all cases, it's very important to coordinate this with your tax professional as well as your advisor to make sure that everything is coordinated across your entire picture. Next.
So just the last, and by the way, I'm Andrew Holmes. I'm a financial planner here at Financial Planning Solutions. So just in different ways that, as financial planners, we're thinking about the different strategies involved here with tax loss harvesting. I know Janet and Lyman both talked a little about this loss carry forwards. So again, if you're accumulating some of those losses, you can use those to offset future gains. So, for some of you that maybe you're considering selling a property at some point down the line, it's going to have a large taxable gain to realize. It could make sense to continue to harvest losses over the next couple years to help to offset against that future taxable gain down the line.
It is, but what if you come off the stock and it actually did better? True.
Oh, we have a question here.
Oh,
I'm not sure. But we'll get to the questions at the end as well. Other things that we're thinking about would just be for those of you that are in retirement, you may be well aware of IRMAA or those increases in terms of your Medicare premiums that are based on income. If there is a possibility to maybe book a loss from one of your investments that can lower your income to qualify for lower Medicare premiums, that can be something that could be worthwhile. And then the last other item that we'll note here is just selling a concentrated stock position. So maybe you've worked for one company majority of your career and you've accumulated a lot of one stock. Even if that stock has done well, you can continue to kind of chip away at some of those concentrated holdings, maybe offsetting some of the gains in that one stock with some of the losses in other positions. So that's another way that you can continually diversify your portfolio. So the last thing that we'll kind of close with is really just some things that are on, I guess our economic calendar towards the end of the year. So the next Federal Reserve meeting will be Wednesday this week. So we'll look for more intel as far as interest rates, both the decision and then kind of the long-term trajectory of rates with the Fed dot plot. We'll be looking at things like the CPI or inflation data for the month of October and November. And then that last Federal Reserve meeting date will be in the middle of December of this year. But I think could be more urgent is just, reasons, I guess, in terms of working with your advisor, please notify your team or our team of, any items that you're considering. Oops. In terms of, I just want to restart my video here. In terms of Roth conversions, if you're considering doing an event like that or charitable gifting, those are items that we're going to really want to know about prior to the end of November, just as it can take some time in terms of working with our custodian to get some of those important year-end action items done. Things with tax loss harvesting in general, a lot of times us as advisors are looking at those items and we'll be looking at it in even more detail leading up to the end of the year as we know more about your 2025 tax situation. So with that, I think we'll toss it back to you guys as far as any questions you may have.
This is John Schumers. I had a couple of questions.
4:16 p.m.
Sure.
Okay.
Yeah.
Your capital gains or losses are treated differently than your regular income, correct? They're lumped together differently. Okay, so the $3,000 limit on tax losses per year, is that a limit on the actual loss, or is that the limit on the tax liability from the loss?
So I can take that. I think it's more so just alluding to, so like if you have a mix of gains and losses throughout the year, those will like net out. So like let's say you had $10,000 in gains on the long-term side and $10,000 in long-term losses, that'll net to like a zero balance on that. But if you had, $15,000 in losses and $10,000 in gains, the first 3,000 of that $5,000 net loss could be used this tax year, and then the other 2,000 would have to be pushed towards the 2026 year as a carry forward.
And
But
it
if
means
you-
that $3,000 is not taxed. Is that what your question is, John?
I guess that's right. But
Yeah.
if you had just a $3,000 loss,
Mhm.
it doesn't give you any you don't have any kind of a tax benefit from that, right?
No, you do.
Because
Yes,
does that
because-
reduce your actual gross
Yes,
taxable income?
yes.
It does because the
Okay.
3,000 is based off of ordinary income. You can deduct it from ordinary income if you're working.
Ah,
So there's two
So-
different like pieces. Here's the investment side, which is the gains and the losses, which can offset each other. But like if you said, if you only had a $3,000 loss that you realized, you sold something, had a $3,000 loss, you could offset ordinary income from that.
okay. If you had a $5,000 loss, you could still only offset ordinary income to $3,000.
Yes.
Correct. And then that 2,000 would carry forward to the future year.
Right.
Yep.
Okay. And you okay, you have to okay. That's kind of what I was trying to figure out because okay, thank you.
Yeah, thanks for the
Sure.
question.
So I guess what that's saying is if you had a bad investment, you had a $10,000 loss, you had an investment that if you sold it would be a $10,000 loss, then it's very prudent to no, you said it could carry forward as as a capital gains loss off your standard income. So you could sell it all in 1 year versus selling it at $3,000 a year for a few years. Okay, because especially if you were scared that not only did you lose that money, but that particular investment's going to get worse. You want to sell it before you lose even more money from your basis. Okay.
Yeah. Another thing to consider is just because you have a loss doesn't always mean you should sell it. Some people feel that they might have a $2,000 loss towards the end of the year, but they really like that investment and they don't want to be out of it for 30 days, that particular investment. So that would be a case to hold it if you really believe long term in it. This is more of a short term
Right.
kind of tax strategy, especially if, we're not generally here buying individual securities, but we do have clients that, have come to us that own some individual stock they've had or inherited or whatever it might be. And it might make sense to take that loss and buy something else to diversify or just be in something that might be doing better that we feel going forward. We got a chat
guess-
question here.
I guess the other tension is if you had an investment that was doing poorly, so if you were to sell it, you get a loss. And you had other investments that were doing well, you'd have to decide whether to sell it and bring your taxable income down. I mean, your long-term investment income down, capital gains down, or to just let it bring down your taxable income because you may be paying a higher tax rate than the capital gains tax rate. Does that make any sense? I mean,
Yeah, I mean, you should look at the value of the investment in general first, right? You
Right.
shouldn't just do it. But if there is an investment that you think has really reached its peak, and you'd like to kind of take advantage of selling it to get that gain, and you also have an investment that has suffered a loss over time, it's just a great strategy to reduce. You could realize that gain up to the loss up to $3,000, and that's helpful to you for this tax year or beyond if you can carry forward that loss. But it really is, we only do this when we feel like the investments we're selling don't have long-term there's
Right.
long-term implications for this, right?
Right.
So we're not just doing it to do it, I guess is
No.
the point.
No, that's right.
Yeah,
Okay.
yeah.
And one other thing to consider is if you're looking online at your accounts and you're looking in that cost basis section, it might not look like you have a loss because you might have had an initial purchase many years ago and then reinvested dividends and capital gains, and maybe you were on some systematic investment plan, so you're buying it all along. But we actually kind of dig a little deeper and look at the different lots to see, which lots might have a loss, and we might sell those and keep some of the others that have a gain. So a lot of times, we've got clients that are looking to raise money too. And so we look at that to
Right.
see how we can sell things to have the least tax impact
Yeah.
if they need money and they don't have enough cash.
Okay. Got it. Thank you.
Rick, you want to address the chat question?
Oh, let me open this up. Okay, so we have a question for tax impact / charitable giving. I'm assuming that this is with respect to giving directly from an account as part of an RMD or required minimum distribution. And 2, at what age should we be speaking to our advisor about giving as part of the on the RMD? So age 70 and a half, you can make a charitable gift called a QCD, a qualified charitable deduction from an IRA to a charity. So around that age would be a good time to start thinking if there's a charity you would like to give to. And that does lower your RMD or your required distribution amount, which is fully taxable. So it could be a good thing to give some money first to the charity and then take your required distribution if there's money left over.
And most people don't have to start taking their RMDs until age 73 now,
Right.
but you can do the QCD once you turn age 70 and a half out of your IRA if you're trying to reduce the amount of the taxable balance there. And of course, you need to be charitably inclined. If you're not charitably inclined, then it's a QCD or a qualified charitable distribution is probably not something that you're going to be considering.
And those are 2 different ages. Yeah, so 70 and a half is when you could start. Most people wait till they have to take a distribution, unless they've got, over $1 million or something in their IRA. But 73 is, or 75 if you're born after 1960, is when you have to start taking those required minimum distributions.
Cool.
I guess the only other thing that I'd mention, going back to my piece of it in looking at the whole picture, is that there are a lot of other things that can be going on in your tax picture. So while we talked about tax loss harvesting as it relates to individual securities, you do need to be mindful of other things that might be going on that could be adding to your taxable income during the tax year. And so at Financial Planning Solutions, we try to coordinate all of those anticipated sources of income, try to plan for years when you might, say, have a lower income year for various reasons, and use that for certain types of either tax loss harvesting or other types of tax-related investment planning decisions. So try not to think of it in one-dimensional terms. Other questions?
Okay.
Hey, is it Dylan that's going to do the wrap up?
Sure. All right, guys. So if there's no more questions, we'll end it here. But if anything comes up, feel free to reach out to your advisor, and we'd be happy to, help out or clarify any questions you might have about tax loss harvesting and how it might apply to you. But Thanks for joining us today, everyone, and take care.
Thank you.
Thank you.
Thanks, everyone.
Bye.
Bye-bye.